People are terrified of taxes in retirement, and in many ways, rightfully so. Now, Roth conversions are a great tool to help reduce this tax problem, but there are many instances where Roth conversions actually do more harm than good. That's why in today's video, I'm going to share with you 4 different scenarios where it probably doesn't make sense for you to do a Roth conversion. Now, real quick, before we jump into why it wouldn't make sense to do a Roth conversion, let's do a quick refresher on why it does make sense to do a Roth conversion. Now, there's many nuances and variables that go beyond this simple explanation, but in general, you would do a Roth conversion if you expect your tax bracket in the future to be much higher or higher at all than your tax bracket today. For example, if today I'm in the 10% tax bracket, and I know for certain I'm going to be in the 22% tax bracket in the future, maybe it makes sense to do some Roth conversions to pay taxes at 10% instead of waiting for the future 22% tax bracket where any withdrawals from my IRA would be taxed at that rate. So the bottom line is it's a strategic way to shift your tax liability into years where it makes more sense for you to pay taxes as opposed to waiting until other years where your tax bill is likely to be higher. So with that in mind, why wouldn't you do a Roth conversion? Well, the first answer is simple. You wouldn't do a Roth conversion if you expect your tax rate in the future to be lower than it is today. This, of course, makes sense because that's just the inverse of the example I just gave. I'm not going to convert today at a higher tax rate if I could just wait until the future to draw funds from my IRA and do so in a lower tax bracket. So that's the first and most obvious reason you wouldn't do a Roth conversion, but let's take this a step further and walk through some common scenarios of why you might be in a lower tax bracket in the future than you are today, even if you're already retired. The most common scenario is probably that you plan on spending less in the future. Let's assume that today you're 65 years old and you just retired. Now today, let's assume maybe you still have a mortgage, maybe you're still helping kids or even grandkids with college expenses, maybe you're traveling a whole lot more, so your income is higher. Because your income is higher, it means you're pulling more money out of IRAs or other investment accounts. Well, because of that, you're going to be in a higher tax bracket, especially if, say, we fast forward 5-10 years, and maybe the mortgage is paid off. Maybe you're not traveling quite as much. Maybe there's not as much family support at that time. So because there's fewer expenses in the future, there's less that you're pulling out of your IRAs and other investment accounts, which means you're in a lower tax bracket. Well, in that example, if you're in a higher tax bracket today because of higher spending, maybe it doesn't make a whole lot of sense to do extra conversions on top of that if you could just wait until the future to draw your IRA balances and do so in a lower tax bracket. I see many people who go into retirement and they're not only supporting their children still, but they're maybe also supporting their own parents. So in addition to their own spending on travel or mortgage or their own lifestyle expenses, they're supporting kids and they're supporting their parents. And because of that, their expenses are higher. Therefore, their income needs to be higher. Therefore, their tax bracket is higher. So as you're doing the analysis for yourself and understanding, should I do Roth conversions or shouldn't I, it's not just about understanding tax brackets today versus wherever tax brackets might be in the future. It's about understanding your own personal taxable income. What does that look like today based upon today's expenses and where you're pulling income from your portfolio versus what might that look like in the future based upon future expenses and the future withdrawals you'll be making from your portfolio. The second reason it might not make sense to do a Roth conversion is that your required minimum distribution is not projected to be an issue. Now, I've talked about this a lot before. What does it mean to be an issue? It's kind of a vague term. Well, in other words, your required minimum distribution isn't projected to push you into a higher tax bracket than you'd otherwise be in. I'm going to circle back on what do I mean by that in just a second, but to start with, I'm doing this number 2, or this is the second reason, because if we go back to example number 1, maybe your expenses will be lower in the future. You say, oh yeah, that makes a lot of sense. My mortgage will be paid off. I won't be traveling as much. I'll be in a much lower tax bracket in the future because I'm not going to spend as much. Well, that could be the case, and you still might be in a higher tax bracket. And the reason for that is even if you're not spending a whole bunch because you want to, you will be required to start drawing money from your IRAs at age 73 or 75, depending on your birth year. So it's very conceivable that even if your lifestyle expenses go down, your taxable income goes up because of those amounts you're going to be required to be taken from your IRAs and other pre-tax retirement accounts. So let's go back to what I said before of your projected required minimum distribution isn't expected to be an issue. How do you know? Well, it's not just with your total portfolio value. For example, let's assume that you have $2 million today and another individual has $2 million today. Does that mean you're going to have the same expected required minimum distribution? No. If your $2 million is all in brokerage accounts, you won't have any required minimum distribution in the future. Versus if another individual's $2 million is all in a traditional IRA, well, their required minimum distributions, their first year of having to take them, is going to be somewhere in the neighborhood of $80,000 per year, assuming the portfolio value is still around $2 million. That $80,000 per year is going to increase. So when you think about that, if you stack that $80,000 of required distribution on top of any Social Security benefits, on top of any dividends or interest, on top of any pension or other income sources you have, you can see how there's a very good chance that starts to push you into higher tax brackets than you'd otherwise be in. So this is where it takes a bit of planning to understand, will this be an issue or not? Well, it depends upon what will your taxable income be like without those required distributions, and then what will the impact of any required distribution be on your taxable income? Is it going to push you into higher and higher tax brackets, or will your required distribution be an amount that, as you project that out, won't dramatically impact your overall tax situation? If it's not expected to dramatically impact your tax situation, there might not be a reason to convert quite as much today from IRAs to Roth IRAs. Now, real quick, before we go any further, if this is helpful at all, make sure that you subscribe to the channel. Make sure that you like this video. I want to make sure that as we're releasing videos every single week, you're getting this information so that you can have the most secure retirement possible. Let's go now to number 3. The third reason you might not want to do a Roth conversion is you do a lot of charitable giving. Now, what on earth does charitable giving have to do with required minimum distributions? First glance, not much, until you start to understand this really powerful planning tool called qualified charitable distributions. A qualified charitable distribution is where the IRS says as soon as you're age 70 and a half, you can start making gifts to charity directly from your IRA. Now, here's how that works. If you're under age 70 and a half and you want to donate money to charity, you can do so, but you have to do so either with cash or with brokerage assets. You cannot use your retirement money to do so. Now, technically you can, but it means you're taking a distribution from your IRA, you're paying taxes on that distribution, and then you're gifting the money to charity. Now, you might say, well, James, sure, but you pay taxes and then you get the tax deduction. Only if you're itemizing your deductions. A lot of people, by the time that they retire, are no longer itemizing their deductions. That's because they maybe don't have a mortgage. That's maybe because their taxes are lower. And so if they're pulling money out of their IRA, they're paying taxes on it, but they're only taking standard deduction. They're not technically getting any deduction for any charitable giving that they're doing, assuming it's under the standard deduction threshold. So the beautiful thing about a qualified charitable distribution is that's money that can go right from your IRA directly to your charity of choice. Now, you don't pay any taxes on this because the money never came to you first and then the charity. It just goes right to the charity. Here's the additional beautiful thing about this. Any qualified charitable distribution you do reduces your required minimum distribution. I shouldn't say it reduces it, but it counts towards it. So if you have a $40,000 required minimum distribution, you do a lot of charitable giving. Let's say you donate $25,000 per year to charity. Well, if you did that right from your IRA, that $25,000 QCD, qualified charitable distribution, counts against the $40,000 that you're required to take out. So you would now only have to take out $15,000 for you after doing that QCD. So if that's you, if you're someone that does a lot of charitable giving, before doing some serious Roth conversions, take a look at a plan first. Is it possible that by using your IRA as the giving tool, you can keep your money in the IRA and you can simply do your giving from there and reduce your required distributions to a point that they don't push you into an unwanted tax bracket? And then the fourth reason that might not make sense to do a lot of Roth conversions is you don't have a long life expectancy. Keep this in mind. Over the last few years, the required minimum distribution age has been pushed back a couple of times. It used to be age 70 and a half. Then it was pushed to 72. Now it's age 73 or 75, depending on your birth year. Now, if you're listening to this and you're saying, oh, well, I maybe am not in the greatest of health and I might not live that long. Well, is there any need to pay excess taxes if you might not be paying required minimum distributions for all that long because maybe you're not expected to live much longer than age 75? Now, you do very much want to take into account beneficiaries. A lot of reasons people do Roth conversions isn't for themselves. They don't necessarily need the monies, but they don't want their children or their heirs to inherit a huge pre-tax account because their heirs will be forced to distribute that within 10 years. So keep that in mind, where it still might make sense to do this even if you don't have a long life expectancy, if you're doing it for your heirs. But say, for example, you don't have anyone that you're leaving money to. You say, you know what, I'm leaving all this money to the animal shelter or to another charity. Well, that charity isn't going to pay taxes on any IRA that they inherit. So there's no reason to do strategic Roth conversions to leave a Roth account to a charity. You could just leave a pre-tax account to a charity. You won't pay taxes on any conversion. They won't pay taxes when they ultimately receive those funds upon your passing. Another thing, along this note or along this line of thinking is every year you live longer, your required distribution increases. For example, at age 75, your required distribution comes out to about 4% of your account balance. So if you have $1 million, you're going to be required to take out about $40,000. Not an exact number, but somewhere around that amount. Now at age 90, the required distribution at that age is about 8.2%. So in that same $1 million portfolio, you're not required to take out $40,000, you're required to take out $82,000 or thereabouts. So as you can start to see, the longer you live, the more impactful these required distributions become. So if you have a really short life expectancy and you're not trying to do any strategic tax planning for heirs, it might not make a lot of sense to do Roth conversions. So anytime I recommend a Roth conversion for a client, I'm first asking myself the question, why shouldn't we do this? Because a Roth conversion means you're paying taxes today, you're prepaying taxes today, sometimes quite a bit in taxes. So before making that commitment, we want to see, is there any good reason that we shouldn't do a Roth conversion? Whether it's because we don't expect required minimum distributions to be an issue, whether it's because we expect that client to be in a lower tax bracket in the future than they are today, whether it's because that client does a ton of charitable giving and we can simply use their IRA as another version of a giving fund, or maybe it's because there's just not a long life expectancy that client has, so why prepay taxes that are unnecessary to pay if they're not going to ultimately reap the benefits of that over the course of a longer life expectancy? So those are 4 good reasons not to do a Roth conversion for the reason that I mentioned. Now, there are many, many cases where it is a good idea to do a Roth conversion. And if you want to see just how impactful that Roth conversion might be, we did a case study that you can check out here. We walked through the steps we took to show a client how could they potentially save $600,000 in taxes through implementing strategic Roth conversions. Check it out and see how that might be applicable to your situation if, after walking through these 4 reasons, you don't think any of them apply to you. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.